Good afternoon and welcome to Cromwell's results presentation for the first half of the 2013 financial year. My name is Paul Waitman, the CEO of Cromwell Property Group. With me is our Financial Director, Darryl Wilson. The summary of the half year is that we've continued to do what we said we'd do. The highlights of the first half include statutory accounting profit of $29.5 million, operating earnings of $45.9 million, up 24% from the $37 million in the first half of the 2012 financial year, a like-for-like increase of 3.8% in net property income, a reduction in gearing from 51% at June 2012 to 44%, raising of $143 million from institutional placements and $39 million from our security purchase plan, the completion of the acquisition of the balance of the Cromwell Property Fund, continuation of momentum in our funds management business with the completion of our Ipswich Fund and the launch of the Box Hill Trust, and maintenance of FY13 operating earnings guidance of not less than 7.5 cents, with distributions of 7.25 cents. In terms of our financial position, we've seen growth in our asset base from the acquisition of CPF portfolio of $168.4 million. Our NTA remains at 71 cents, and more on that, and our expectations of movement in property values in due course. Following the settlement of the placement, the SPP and the sale of a non-core asset in Adelaide, our gearing's been reduced to 44%, which provides the capacity for us to pursue attractive opportunities. Turning to our debt facilities, we remain diversified across 7 facilities with varying maturity dates. Our lenders comprise the major Australian banks and one offshore bank. We have no material maturities until May 2014. We see opportunity in coming years to achieve savings and increase in tenor of our debt facilities as the debt markets continue to change and develop. Consistent with our board's strategy of providing certainty to our forward distributions by maintaining a minimum 2-year hedging profile, we took advantage of recent market lows to extend our swap profile and reduce our cost of debt. Our weighted average swap term has been extended to 2.9 years, providing a high degree of certainty over our interest expense in the second half of this financial year and into FY14. There is some scope for us to benefit from current low interest rates in 2014 as hedges expire and roll off. Both the institutional placement and the SPP were materially oversubscribed. Our largest shareholder, Redefine, maintained its holding of approximately 27%. As a result of the initiatives, we're well positioned to take advantage of market opportunities with a strong working capital position. The funds were initially applied to debt reduction as to $19 million and in seeding the Box Hill Trust for a further $19 million. The balance of funds are available for further acquisitions and funds management initiatives. Our property portfolio remains well diversified across the Brisbane, Sydney, Melbourne and Canberra markets. We've got a totally domestic Australian portfolio with approximately 91.5% allocated to the office sector. 84% of rental income comes from government or listed tenants. Our weighted average lease expiry profile of 6 years is one of the longest in the sector. The total value of the portfolio increased to $1.9 billion following the acquisition of the CPF portfolio. We maintain an attractive lease expiry profile with an average of only 8.8% of leases expiring in the financial years 2014 to 2016. So we've got minimal exposure to what many regard as a soft leasing market at the current time. Our refurbishment of 100 Weymouth Street is due to be completed in March 2013. We have a 15-year commitment over 25% of the building, and we're marketing the balance of space with expectation of substantial commitments during this calendar year. Other leasing achievements in the first half of the 2013 year include new 9-year leases for our Brooklyn and Gilman wall stores, over 136 square metres in space, and a new 10-year lease over 6,100 square metres at our 380 La Trobe Street property. As many in the sector will be aware, we have explored a large number of opportunities to acquire existing funds management platforms in the last 5 years. Our focus in recent times has been to grow our funds management business organically and avoid the legacy issues that constrain the platforms that encountered difficulties in the GFC. This strategy allows us to capitalise on the strong reputation we maintained through the global financial crisis and to build relationships unfettered by the problems of the past. I did say once that with some of the platforms that we looked at, we would have been happy to drive the ambulance, but we didn't want to drive the hearse. I think we're now showing the benefits of building and driving our own bus. In terms of our retail direct property funds, the Ipswich City Heart Trust closed early and oversubscribed in October. The Box Hill Trust is experiencing significant early demand and will close during 2013. We're targeting the launch of a further unlisted fund in the first half of the 2014 financial year, and we're seeing significant inflows from direct retail subscribers and demand growing from larger dealer groups. Our property securities fund, Phoenix Portfolios, has increased its funds under management to over $300 million, and our focus in the second half and into 2014 will be to grow the size of funds under management through our retail channels. Our distribution base continues to grow. We've got over 13,000 retail investors on our balance sheet. Our retail investor database has been expanded to 22,000 qualified potential investors, 4,000 of which are current fund investors. And we have initiatives in place to add 5,000 plus new pre-qualified investors in the next 12 months. This is the main focus for growing our distribution base. However, we continue to focus on boutique advisors, many of whom are long-term supporters, and in growing support from the larger wealth managers, who are all showing interest again in direct property. Each of these larger wealth managers can bring substantial volume once they commit to the sector. To access these platforms, we need a combination of product approval and platform inclusion to maximise inflows, and we're vigorously pursuing both initiatives. We see in the market that many of our competitors are now moving their focus to targeting wholesale fundraising and in wholesale institutional clients. That gives us greater potential to grow and expand our market share. The barriers to entry and to scale in this business are now substantial, and we feel that this business is in the right place at the right time. Our core strategy is based on 4 pillars: to provide defensive, superior risk-adjusted returns from a 100% domestic Australian portfolio, to invest in high-quality office assets in predominantly CBD and core fringe markets, and to seek assets which offer the potential for superior returns through active asset management. We look to leverage our property capabilities and to provide additional earnings growth through the expansion of our funds management business. Our continuing commitment to this strategy has seen Cromwell significantly outperform the S&P ASX 300 A-REIT accumulation index since we stapled in 2006. We've demonstrated outperformance of 6.6% and 14.8% per annum over 3 and 5 years respectively, and we're rated in the top quartile of managers rated by IPD since inception in 1999. In terms of where we sit with our peers, Cromwell offers superior yields and growth compared to our peer group. We can demonstrate a 110 basis point premium to the average FY13 EPS yield of our peer group and a 200 basis point premium to the average FY13 DPS yield of our peer group. We believe that our focus on long-term leases and quality tenants represents the best risk-adjusted return on equity in the current environment, and our funds management earnings can grow with minimal committed equity and limited working capital. Future growth drivers for Cromwell include an average fixed property rental growth of 3.8% for the 2013 financial year, This underpins our income in what many see as currently a soft market. Growth in earnings from increased activity in funds management businesses. This is driven by the current premium of property yields to bonds, cash yields at the present time, resulting in a strong appetite for yield, coupled with the desire for low volatility from retail investors. At this point in the capital raising for our Box Hill Trust, we're considerably in excess of where we were with Ipswich City Heart Trust, demonstrating a growing appetite for such funds. We're actively sourcing product for the next unlisted fund launch. We see potential and earnings upside from low base interest rates over time. Whilst we've got a current average cost of debt of 6.4% based on existing hedged rates, the cost of new debt is considerably cheaper at 5.25% or lower. The majority of our hedges expire over the next 3 years, leading to a potential lowering of interest costs over this period. In addition to these organic factors, we've got potential for growth through accretive opportunistic acquisitions. The capital available to us through recent equity raisings and the continuing capital recycling program from non-core assets will put us in an attractive position to take advantage of these opportunities. We'll continue to maintain our disciplined approach to new acquisitions in evaluating these opportunities as they arise. But we will be seeking to deploy funds during the 2013 financial year. Looking to the performance of our property portfolio, clearly yield is in demand. Property yield premiums to bond rates are at historic highs. We're expecting compression in valuations from cap rate compression in 2013, providing upside to our NTA and our gearing. There is obviously significant demand now for all core direct property, and we're seeing evidence of increased competition for all assets. We expect that this will translate to cap rate compression across all classes of property over time, but we see real opportunity in the core plus secondary asset space, for which there's not yet developed demand and in respect of which there is a significant margin in yield over core property. We'll continue to seek investment property opportunities that are consistent with our strategy. That includes allocating capital to markets with what we determine to be the best growth potential ahead of the cycle, our continuing focus on improving portfolio quality and maintaining our disciplines in transaction activity. The focus for us will continue to remain on the office sector, which we expect to offer the best opportunities over the next 2 to 3 years, with significant allocation continuing to Sydney, Brisbane, Melbourne and Canberra. We're able to reaffirm previous guidance of operating earnings to be at least 7.5 cents in the 2013 financial yield, representing an 8.3% yield on our current trading price. Growth in property income in 2013 has been partially offset by having 100 Weymouth Street offline. That refurbishment will be completed in March, and we expect to have the asset producing earnings in the 2014 year. We also expect to see benefit from an increase in funds management earnings. We continue our focus on maximising cash flow to security holders. Our distributions are expected to be 7.25 cents in 2013 financial year, representing an 8.1% yield on our current trading price. Having a simple balance sheet and minimal development exposure enables us to maintain a payout ratio in excess of 90%. We're continuing to target growth in our NTA and in operating earnings per security. Minimum rental increases will underpin property earnings, and we expect to benefit significantly from improving valuations if yield compression occurs. We're targeting improvement in our debt profile over the next 1 to 2 years as the capital markets change and as increased appetite emerges from institutional investors for property debt. Importantly, we've flagged the potential for inclusion in indexes over time. One of the byproducts of our recent capital raising has been to broaden the base of our institutional investors, and this in turn has led to substantial improvement in liquidity. Cromwell's currently ranked 124th in our free float market cap, and we believe liquidity has built to levels which should enable qualification for inclusion in the S&P ASX 300 in the short to medium term. Thank you very much for participating today. Now I'll throw it back to the operator to take any questions that you may have for me or Darryl. All right, well, thank you very much. There being no questions, we'll close the session. I think we've flagged a number of roadshows and presentations over the course of the coming month, so we'll look forward to catching up with each of you and dealing with any issues you have in detail at that time. Thank you very much.